Well, last night Scott Morrison delivered his second budget, and we thought last year was pretty harsh. Well, this year was quite a softly approach on tax-related changes, and I thought I'd walk you through today just the big ticket items that will affect you and your businesses in the upcoming years to come. The tax-related changes, we were worried in the lead up this budget, because we knew that the government were going to try and raise revenue, that they'd confirm or renew that 2% temporary deficit levy that's been put on the top tax rate. So at the moment the top tax rate's 49% when you include Medicare levy. Well, that's scheduled to finish at 30 June 17. Well, thankfully last night in the budget they confirmed that would come to an end, so the top rate would drop back to 47% and that 2% debt levy is being removed. The problem that also comes with that is at the same time the government have lifted the Medicare levy from 2% to 2.5% from 1 July 2019. So in essence, in 2 years' time, the top rate will be 47.5 cents in the dollar for those incomes above $180,000. And that Medicare change is going to raise a significant amount of revenue from the government. I think that's their big ticket item, but unfortunately it will affect everybody in the community, not just the top income earners. Another tax-related change that we're getting more and more queries on is obviously our children are getting older and going off to uni, and we worry about their HECS repayment when we want to introduce the children into our income sharing type approach to save tax. And historically the HECS threshold before you have to pay any HECS back to the government cuts in around $55,000 of taxable income for the child. That is being reduced to $42,000, and you'll have to pay 1% of their taxable income once they hit $42,000. So what the government is trying to do is get children or students to pay back their HECS more quickly, and we'll need to factor that in when we want to bring your children into your tax planning scenarios to ensure that we factor in this extra HECS payment. Another piece of great news for businesses that is probably needs everyone to be reminded of this particular change is, as you all should know, small businesses, and that is at the moment a business with a turnover less than $10 million per annum, can claim an immediate tax deduction for plant and equipment that costs less than $20,000. Now that was scheduled to end this coming 30 June 2017. Well, the government last night, in what is a very positive move, have extended that for a further 12 months to 30 June 18. Now that's wonderful in itself, but it's also very worthy of reminding you that when this was introduced a year or two ago, it was only for businesses under 2 million in turnover. That has since been changed to 10 million in turnover. So that expands the amount of businesses that can take advantage of this very generous concession. So we were rushing around telling people to perhaps buy equipment before 30 June 17. The rush is not that important now because we have a further 12 months to take advantage of this very generous concession. Another small change that probably excites accountants more than it does clients is the government are tightening up the small business concessions. Nothing major, but there's been some loopholes we've been able to take advantage of to claim the concessions and pay very little tax on assets that perhaps weren't directly connected with the business. Well, unfortunately, as with all things, they find out about these loopholes and close them. So they're going to narrow the assets that can be claimed for the small business concession, but it shouldn't have a great impact generally, but they've just unfortunately closed some loopholes on us. Just some small GST change that, well, it appears small, but I think if you're affected it would appear quite large. If you're selling new residential property, that is mainly a property developer, traditionally a property developer would settle the premises or the houses or the units and then pay GST in their upcoming business activity statement. Well, what appears to be happening is that some developers are not remitting the GST off. They're settling, getting the money from the purchasers, and then dudding the government. So essentially what the government is requiring is upon settlement of residential premises, new residential premises, the GST will be payable at settlement. So it seems that they're moving the obligation to pay the GST to the purchaser. Now I don't know how this will work from an administrative perspective. It will happen on settlement, but perhaps when checks are drawn by the bank, GST has got to be dealt with at that time. So we'll have to wait and see the detail, but for most developers it's just going to involve a small timing issue that they're paying the GST perhaps a few months earlier, but at the end of the day the amount of GST is going to remain the same. It's just the timing is affected. Last night, obviously, the key part of the budget was about housing affordability, and there were quite a lot of tax-related housing measures that I would like to talk about now that really have an accumulative impact. No, there's nothing major, but each one has a separate impact that if you're affected by quite a few of them, you'll notice the difference. The first change, and it seems to be driven by this perception that a lot of properties are owned by foreigners, foreign residents, and they're kept vacant. So in essence, if you are a foreign owner of an Australian residential property and that property is vacant and you're not seeking to put a tenant in, you'll be charged a levy, a fee, which is a per annum fee, which is equivalent to the charge that the Foreign Investment Review Board charges when you apply to acquire the property. So it's an ongoing financial penalty for the fact you're keeping your property vacant. Now, whether that would motivate foreign owners to rent their property out, I don't know, but the government is clearly trying to encourage people to stop warehousing vacant properties. Another interesting sleeper in the budget last night that I think nearly every client who owns a rental property uses, so we just need to be careful about this one, is that when you buy a residential property, we often tell you to go get a quantity surveyor report, and in that report you're able to claim building depreciation and plant and equipment depreciation, and that passes on for each subsequent purchaser of the property. Well, in the budget last night, the government said, look, we are not going to allow purchasers of properties after today, or from today, to claim depreciation on plant and equipment that they've essentially acquired off another person through the purchase of the home. So to give an example, I buy an apartment that has stoves and plant that comes with the sale that were bought by the former owner. I can't claim depreciation on those items anymore. They just form part of the cost of the unit. And that, it could be worth a couple of $1,000s a year to people who buy rental properties. Now, existing properties that were owned as last night are grandfathered. It's only properties that are acquired after today. Another little one we see all the time is clients love buying rental properties in nice exotic locations and saying, I get to claim a tax deduction to go visit my rental property. Only this week someone said I own a property in the US and I get to go and look at that property and I'm allowed a tax deduction. Well, technically that is actually correct, but as of last night, the government is amending the law that you no longer can claim a tax deduction for a trip to visit a rental property. Because obviously this is part of the raft of measures to make perhaps it less appealing to buy rental properties, and obviously being able to travel to a nice location to visit your property was an incentive to buy a property. They're just removing that incentive. So unfortunately, no more deductions for trips to visit and inspect your rental properties. A change that I don't know whether will be that common is that they're trying to encourage people to invest in affordable housing. And one of the ways they're doing that is they're extending or increasing the capital gains tax discount. So we roughly all get a 50% discount from capital gains tax when we acquire an asset and make a capital gain, provided we've held that asset for more than 12 months. That discount of 50% will be increased to 60% if the investment is in what's called affordable housing. And the best definition I can read out of the budget papers, it's housing where it's managed by a semi-government body or a housing cooperative. It's rented to tenants for below market value, so it's designed to give housing to those who perhaps can't afford the housing issue that we have in Australia. Some people can't afford to live in the houses they want to live in. So through the affordable housing system, you can buy a property, let it be managed by one of these bodies, and to rent it out to affordable housing community, and you get a 60% discount from capital gains tax. Now, I don't know whether that's a big ticket item because you are renting a property out at below market value, but nevertheless, if you are interested in investing in affordable housing, there's that incentive that you actually get a further discount from capital gains tax. Another change that the government made last night is in relation to the ability of non-resident property owners in Australia to claim the main residence exemption, because technically it has been able to be done where a non-resident lived in the house for a period of time and they continued to claim that house as the main residence. So in essence, as of last night, if a non-resident purchases a home from today, they will be ineligible to claim it as their main residence, but existing holdings are grandfathered out till 30 June 2019. So if you are a non-resident who happens to be able to claim a home in Australia as a main residence, that will continue to be exempt till 30 June 2019. But if you are looking to buy a new home from today, you cannot claim it as your main residence, so you will be fully accessible to capital gains. From 1 July 2017, the government has amended the withholding when a non-resident sells a property in Australia. So you may remember I think it was last year's budget, the government brought in a withholding tax when a non-resident sells property in Australia, and it was 10% of the property value for sales above $2 million. And so that means that when a non-resident is a party to a transaction, the purchaser, absent any exemption certificate, has to pay off 10% to the tax office upon settlement. Well, last night in the budget, they amended that to bring the rate up from 10% to 12.5%, and bring the value where this withholding kicks in from $2 million to $750,000. So from 1 July 17, we're going to have a lot more properties impacted by this withholding tax. And often people go, oh, I'm a resident, it doesn't really worry me. But when you are a resident, you still need a clearance certificate from the government, and most lawyers are fully aware of this, and it's all pretty standardised now. But unfortunately, we hadn't seen too much of it. It's only kicked in at $2 million. Well, from 1 July 17, it comes in at $750,000. So we will unfortunately see a lot more action in this area because the amount of properties will now be affected by this particular change. Just moving on to the superannuation changes, you may recall last year was a massive year for super changes in the budget, and this year it's quite minor. One that is intriguing, but we know, as usual, none of the detail, is the ability for what they call people who downsize their home to make additional contributions into superannuation. So the announcement contains the following type scenario where you're basically over 65, you sell a home you've owned for more than 10 years to downsize. Now they haven't defined what downsize means, but let's assume you're selling to move into a retirement village or something like that. You're able to put in up to $300,000 per person for a couple, or $300,000 if you're single, from the proceeds of that sale into superannuation. That's in addition to any other caps. And also you don't need to have met the work test, which is often a requirement when you're over 65. You can't often put more money into superannuation unless you're working. So this seemed to be like a one-off opportunity, but I'm sure it will be more complicated than it sounds, because it sounds to me that they're going to need to regulate this pretty heavily, because how do you define downsizing? What if you're just changing main residence and you're buying something else of an equivalent size or value? So I wouldn't be too excited about this one, but we'll wait and see in the detail. As many of you know, the changes from last year's budget in relation to superannuation have just caused so much work and advice needed to get everything ready for this 1 July 17 change date. And one of the big things that come out of last year's budget is looking at people's super balances and treating them differently, whether their superannuation balance is above or below $1.6 million. And that 1.6 is quite an important threshold for a bunch of different reasons. What the government did last night is they've amended the legislation to say, look, when you're calculating the $1.6 million and a fund that you're working on has one of these limited recourse borrowing arrangements, that is where a fund can borrow and go buy an asset, you have to add back the value of the outstanding borrowing. So it's like they're ignoring the liability in calculating that 1.6. So that will mean, in a practical sense, many clients we've spoken to in the last 6 to 12 months whose balances might have been below 1.6, who have borrowed using one of these limited recourse borrowing arrangements, may find themselves, when we make the calculation adjustment, that you'll be over 1.6. So there will be some further consequences. So again, we'll be in touch with you if this change does impact you, but it's not meant to raise a lot of revenue according to the government calculation, but I think it will affect quite a few clients that I've been speaking to who have been below the limits. I'm going, no, you're good, but they have borrowed, so I have to add that borrowing back now to the balance, and that may mean they exceed the threshold. But that's something we'll have to work with you in the incoming months. The final change that I would like to quickly talk about, and again, I'm a little sceptical about these things, it's the First Home Owner Saver Scheme. And in essence, the government is obviously trying to encourage younger people to save for a deposit. and this is the last of the housing measures, the tax-related housing measures I'm going to talk about. In essence, from 1 July 17, young people are able to contribute into superannuation $15,000 a year, capped to 30, so 30,000. So it's like they're saying you can do it over 2 years at 15. A contribution to superannuation which you're able to withdraw, and when you withdraw it, it's concessionally taxed, so the tax is just your normal rate minus a 30% offset, and you can withdraw it with the earnings that it made in the fund to fund your deposit in for your first home. As with all these type of schemes, they get over regulated, so I don't know how attractive it will be and how many people will take it up, but it's something that if you have, if you're interested in buying your first home, or your child is, we'll wait and see the detail. The first contributions can be made after 1 July 17. The first withdrawals can't be made until the 2019 year, as I understand it. So look, all we've got is an announcement. We'll wait and see on the detail, and if it is relevant, then we'll help you walk through those issues. Well, as you can see, there was a bit of a mixed bag there. Nothing earth-shattering, unfortunately for us, compared to last year. If any of these changes, you want to know more about them, or you're interested to know whether you're impacted by them, feel free to reach out to the contact within WMS, and we'll work together to see how they do impact you. Unfortunately, with these things, we have to rely on 2 paragraphs of a description. We don't see the detail, but at least we can give you a bit of a heads up on what might happen and what you might need to do. And again, reach out to anyone in the firm or myself if you've got any queries on anything we've talked about today.